Hi, Steve Van Metre here, and welcome to your Monday Night Premiere. We take about 15 minutes every Monday and Wednesday night trying to make sense of markets that don't really make any sense. So, of course, the news over the weekend was dominated by the coronavirus, and I'm not going to get into any specifics about it. There are plenty of other places to get better information that I'm going to share with you, but I want to talk about it from an impact on the market and the economy, because that's really what we're here for. And when we get into the charts, I want you to keep in mind, the markets make the news. The news does not make the markets. There's some coincidences that are occurring right at the time as the coronavirus appears to be broadening its horizon, so to speak. So from an economic point, from a markets point, what does it mean when people are afraid of getting sick and potentially dying? Well, it means people will cancel travel plans, stop going places, going out to eat. Maybe in certain countries they will be restricted, like China, where they can't really go very many places. And what does this mean from a demand component? Goes down. And the problem isn't that the economy can't absorb an external shock, such as a coronavirus or something else. It can. The global economy, the U.S. economy, is very, very, very resilient. The problem is when things happen at a point of weakness. So right now, you have oil trading around, I should have looked, I think close around $53 a barrel. What do we know about oil? Well, we know under 60, a lot of companies aren't making money. We know under 55, we're below the Permian break even. So at 52 or 53, wherever it settled in today, what does that tell us about the health of the energy sector, which is predominantly dominated by oil companies? It tells us things are bad. Now, imagine you get a coronavirus when oil's at, say, 80 a barrel or 85 a barrel, and it comes down, $5 down to 75 or $10 down to 75. The oil companies are still making money. Yeah, they're not making as much. Perhaps demand falls back. Yeah, okay, it's not good in a couple of months, assuming the virus gets contained and goes away, that, demand eventually kicks back up and price goes back, rises, and the oil companies are A-okay. At 52 to 53 a barrel, you have a huge, massive problem where oil companies are not making, and when I say oil companies I'm not always saying that this is the majors. I mean, you guys think there's a lot of tiny little oil services companies out there that their livelihood depends on the price of oil. So when it falls below a certain point, even though they may not be a producer, they may just be drilling wells, they know they're out of work. And that's the problem with the coronavirus at this time, is the global economy is extremely weak. And it needs every bit of ounce of growth story to keep it going. And so when you have something like the coronavirus that brings oil prices down, and will probably bring them down further, and you have Boeing with their 737 MAX problem that has shut down their production of it, which is going to domino down the supply chain, these are all problems. Maybe Boeing gets certified, maybe the MAX gets recertified to fly by summer. I don't know. It may be too late. Maybe the coronavirus goes away in a month or two. It may be too late. Not from that standpoint, from the economic standpoint, is can the economy recover? Because when we look at lending growth, it's really weak, although Boeing just grabbed $12 billion in loans, so that will help the commercial and industrial lending data in the coming weeks. But nevertheless, that is the issue, is the economy is really weak, and they don't know if it can recover. So let's take a look at how hedge fund managers are positioned, and then we will take a look at some charts to see how the markets make the news, not the other way around. So here we are on hedgeopia.com, and we can see the 10-year Treasury, speculators and 10-year Treasury futures are still very short. This is as of Tuesday last week. Now, I'm going to imagine that they've started to unwind these positions. So what you're seeing is speculators betting on higher interest rates, as here in red, interest rates are headed lower. So from a positioning standpoint, speculators want to buy now. They're buying these hedges, these speculative positions, to sell them later, or buy them, to buy them later when prices are lower. So they're selling today to buy later, whereas the smart money who is on the opposite end of this position is buying buying the opportunity, or taking the opportunity to buy bonds at current prices when they're higher in the future. So we see the positioning for speculators is still short, not a good sign for them. Looking at the long bond, 30-year bond, we see they are also very short. I'm going to imagine this has been backed off since last Tuesday as well. But what you can see is they're betting on higher interest rates. They're betting on reflation. Now, obviously, when you have the 737 MAX shut down, production line shut down, and you have fears of the coronavirus spreading and people canceling travel plans, in some cases being forced to cancel those plans, as you know, specifically in China, which is the biggest holiday, Chinese New Year right now, and people are stuck, which they normally travel, normally spend money. Well, they're not going to spend as much. That will hurt demand. As we look at oil, and this is probably, people ask me, how can you be so bearish on oil? Why do you think oil prices are going to go so low? Because you have the second largest speculative long position in crude oil. This doesn't count all the long positions in the different oil company stocks. So imagine when these speculators realize that oil prices are going to continue to head down, they're going to go running out of these positions. And where did they take this big increase? Well, right here around 55 a barrel. So what does that tell us? They are underwater for most of these positions through here. So ever since earlier this year, as they ramped up their long position, they are at a net loss as of right now. If oil should fall back down to, say, 43 a barrel, they will be at a net loss all the way through the end of last year. And if these positions get unwound, you can only imagine how low oil is going to go, and that is going to have a knock-on effect of causing a lot of small oil producers to file bankruptcy. And you see that in the charts. Looking at the S&P 500, you see they backed off their longs a little bit. Probably good timing on that. And taking a look at gold, largest position, speculative long position in gold. I still don't see this as a breakout, but everyone's calling it. The dollar should rally, if anything, due to a dollar shortage, and that should bring gold down much lower and be a nice opportunity to jump into that sector there. NASDAQ 100 they backed off their longs a little bit. And Russell 2000, they're very bullish on the U.S. economy. If you want to know the difference between the S&P, NASDAQ, and the Russell from an investment standpoint of what country, the Russell has the most U.S. companies in it. So they're very bullish on the U.S. economy. You can see that here very long, and that is headed lower today as well. And they backed off their dollar longs. Again, this doesn't make much sense because in a dollar shortage, the dollar should rise. And when you get an unwind where people are forced to liquidate positions. So if I'm short, and I'm not, but if I was short up here, say 30 years, and I have to get out of these short positions, what do I need to do? Well, I need to buy a long position. Well, how do I buy a long position? Well, I need cash. What if I don't have any cash because cash is in short supply? Well, that means I got to go sell some stocks. Maybe I go sell some of my tech stocks to raise cash, but what does that do? It puts a demand for the dollar to go up as people scramble for cash. So when markets start unwinding, and they will at some point, the dollar should rally, it brings gold down. And then from a volatility standpoint, we see that speculators increase their volatility shorts at probably a very, very bad time. I'm sure many of them are wishing today they did not do that. But let's go ahead and take a look at some charts, and then we'll round out our time here. So the S&P 500 gapped lower in overnight trading and could not really find buyers. It did for a while and then gave those up by market close. Looking at the small caps, remember, speculators are fairly long here. You can see selling. They're trying to bid it back up, but in the end of the day, that closed lower. But let's take a look at the bond market, because this is where the market really makes the news. And obviously, if you're listening to this, you must know I love bonds and going into late cycle, because it's where you get your biggest play in the market. Is, you can make equity-like returns in the bond market while collecting a dividend. It's crazy, but it has happened in the past, will probably happen again. So here you can see that this was a consolidation pattern in a longer term downward trend, which I said, when you get a top, a move down, and then you get this counter rally, everyone thought this was going to lead to higher interest rates, and the data is completely suggested otherwise, but it didn't stop the market from shorting and selling bonds like crazy. And now what has happened is we see a trend line break on 10-year treasuries right here at 1.6 or 1.7%, kind of as predicted that this would start leading to a fall off in interest rates, because what happens is all the people that were short here, and here are all now in lost positions. And one of the ways you can hedge your loss is to buy bonds. And we're not seeing that in the trading volume where they're buying a whole lot, but that will come. So what this is suggesting is the smart money not only bought all the inventory way up here and drove yields down, they bought all the last of the inventory here to see a much larger decline. And how do we know that's coming? Well, we have the largest topping pattern in 10-year treasuries in history, with support right around 1.4%. So we're at 1.6% and falling. Now it may rebound some tomorrow, but the general direction of this will be lower. And it's important to note that none of these computer models are chasing this lower yet. So wait until some of those computerized models start shifting out of stocks and into bonds, and you'll watch this thing start to get some momentum. If it breaks through this triple bottom, which it will, because there's no such thing as quadruple bottoms, and if you find one, they're very unusual. But here you have a triple bottom. When this breaks through, you're watching 10-year treasury yields head zero or probably even negative. And now let's take a look at 30-year treasuries. They too broke. I didn't draw the trend line in, but they broke through at 2.2. I said that was a critical juncture, broke through, and now yields are almost back to their October lows. And as I mentioned, once they will revisit those lows, there are some gaps to fill right here at the all-time lows. And once you get down there, it's the same story, just slightly different pattern on the 30-year. Is you have, going back to 2012, you have a bottom, a lower low, and now a lower low here. When this breaks through, my prediction is you're going to see 30-year yields around 1% or less. And if you own zero coupon 30-year bonds, you can pat yourself on the back when you make your 50% return in the bond market when stocks are unwinding. Because what will happen is the relationship between stocks and bonds is simple. Interest rates and stock prices should go up. They don't have to go up exactly the other, but they should. So when one's going down, I'm not good at this pointing and reverse thing, but when interest rates go down and stock prices are going up, one of the two is going to be right. And right now the bond market is saying we're going to pull stock prices down. So if you want to be a smart money, you buy bonds, let bond market make its profit, pull stock market down, and then you flip over and buy whatever risk assets you happen to like. Let's take a look at some oil company stocks. Here's symbol XOP, oil and gas producers or explorers. You can see now all-time lows as of today. And this is you can almost go back and say, here's a huge topping pattern that goes all the way back to 2008. This is suggesting that oil company stocks are headed near zero. A lot of these small producers will not make it. And I'm not saying that to pick on the oil industry. I'm saying is I happen to have seen how much debt a lot of these small producers have. And when you have a lot of debt and you're losing money, you go bankrupt. And you can see it's happening in the oil market. If we look at XLE, which is the energy sector, you can see it's breaking support today, close below this trend line that I drew in at $55.50 a share. So if you are charting things at home, you can draw it there, but I am not the foremost expert on charting. What this suggests is the next level of support for XLE is at $50 a share. And as we know, due to the relationship between XLE and ExxonMobil, because effectively XLE is 20% ExxonMobil, the other part is Chevron stock, or the other 20% would be Chevron. So 40% is two companies. You can see ExxonMobil is now trading at closed at 64.74. This is in a major 12-year topping pattern that suggests that ExxonMobil's next area of support is around 60 to 62. And reality, because this thing is in so many different ETFs and mutual funds, is one of the most broadly owned stocks in the market, it can easily yank the market down. And let's close out by taking a look at TLT. And here you can see again, the markets make the news. Here's that consolidation pattern. We went up. When you get a triangle pattern after a major move off of a bottom, it's often a continuation pattern. And usually it breaks that pattern right into here. But this time we went all the way to the end. And now look, in just a matter of 5 or 6 trading days, we're back almost near the October highs with lots of room to run. And you're not seeing a ton of trading volume here, which means a lot of these short sellers are still in lost positions holding on, but at some point they'll give up. When you see TLT break this all-time high, it's got nothing but bond market blue sky ahead of it. And that means there's big returns for the bond market. So I'm Steve Van Metre. Thanks for watching. We'll be back Wednesday night to see what the markets bring us then. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation by selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity, opinions expressed in video that I own and do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.